plans to exceed the minimum standards that apply, then in those areas where they exceed will be measured by the ISO representative, and you can gather points. And the points can, start with a 5% reduction in premium for people in your community. It can go up to a 45% reduction. I don't know anybody has that. But that's subject to annual review. The community has to be in good stead with FEMA. If the state or FEMA has recently done visits or reviews, and it looks like the community's not paying attention to the floodplain ordinances, that has to be handled, before we move forward. But that would be the one area would be the community rating system, and they tend to, be a group. So one community might hear what the other community is doing that might have been impacted the insurance premiums. But the overall concept is that the community would want to manage the floodplain to standards in excess of the minimal that would be required.
I have a comment on the insurance presentation. You used the term phase-in, and I got really confused. I think what it is phase out of subsidies, and you might want to change that around. The other question I have is basically the maps. We have a couple of names you might remember: Sandy, Irene. These are considered 1,000-year storms that seem to be the new normal. Do these new maps reflect that? And is there any anticipation that we're sort of, with the global warming, seeing much more violent storms, and that these maps will get redrawn much sooner than 20 years?
So like I talked about, still water elevations that we go through. So we do observations. It's what at the end of the day, in a flood insurance rate maps or actuarial product, you're paying insurance, so you want to be paying insurance on kind of a now situation, not a forecasting future potential situation. So what we do is we look back through time, we look at the history of the events that have occurred, and we have tied observations at a certain number of stations. We go through, we take out all the high marks of the storm events, and we look at, we do external fits on those, and then come up with what's the 1% chance of that. And so, in essence, we're capturing sea level rise from the standpoint of sea level has risen over the past 100 years, and so we can see that in the record. If you look at the Boston gauge record, you'll see it go up, and they actually know that it's rising at almost 3 millimeters per year. And so we're able to see this increase in still water elevations. And then as the events happen, we're able to capture more and more events in the record. So we're able to have more events that are considered extremal events. And by extremal, we mean anything over probably a 10% chance of occurrence. I don't know, I can kind of off the top of my head, just because I was talking to people from Marblehead earlier today, but the old still water elevation was 8.8 feet. The new still water elevation is 10.0. And so that 1% chance shift of 1.2 feet is an incorporation of both the observation of sea level rise sliding up, as well as kind of the inclusion of additional storm events. The maps that were made, in the mid-80s, they probably were looking at events up to 1980 or so, and we've added up to 2010. So we're looking at additional 30 years worth of observations as well as sea level rise. So we're seeing that actual slide. I agree with you that I would expect us to come back probably as sea level continues to happen and there's some threshold that gets met as far as what the actual observed rise is and the need to come back and redo the maps.
The other thing I wanted to add, and Brian, I'm sure you can verify this, is that actually, Sandy, I know for sure, at least in the New England states, was not even a 1% event.
Yes.
I know in Rhode Island.
So the joys you get to do on a Saturday morning in machine ecology at 8 a.m. and says we need this number by 9. From eastern Connecticut, we're in a 1 in chance of happening. As we move our way through Connecticut, through the middle of Connecticut, it got down to a 1 in 75. As we moved through to the border with Rhode Island, it got to 1 on 50. As we got to Newport, it dropped down to 1 on 30. And then down London's Bay, it was not even really observable as far as the still water elevations went. It's kind of below just the tidal fields. And then up in Boston, it actually ended up being close to about mean high water, which wasn't forecasted for that day, but that's what was observed.
Good evening. My name is Deborah Panetta. I'm one of the 5 selectmen in the town of Saugus, and I first would like to thank you for holding this forum this evening. It was very informative. My question is, the number one question that I get from my constituents is why? Why the map's changing? There are people who have never been flooded before. People have never had an ounce of water come through their basements. And now all of a sudden, they're getting a significant bill that they have to deal with. Now I understand that there's a process, there was a due determination on how those maps have been situated. But I need to be able to explain it to them simply. I need to be able to explain it to myself simply. And there are hundreds and hundreds and hundreds of homes that are being negatively impacted by this change in the map. And then what I also thought I heard you say is that for the next 4 years, you're going to see, the homeowner is going to see a 25% increase year over year to pay for, to help subsidize. No, that's not what I'm hearing? Okay.
That's just a small percentage.
A small percentage. Okay, if you can answer that question, it'd be most appreciated. And again, thank you.
I'll just start off with a little bit at the beginning. So the National Flood Insurance Program draws these maps to characterize a 1% event. I think what society realizes is that a lot of the events that we see aren't even 1% events. Like in our community, on an annual basis, you have a 1 in 100 chance. The old term that we used to use was the 100-year event. The problem with that, people thought, if I have it happen right now, I'll be good for 100 years. So it's actuarial statistical number, but I think when they developed the program, they saw how a lot of us could not really conceptualize 1% event, you know? I totally understand that. So, like we've been talking about, Sandy was, you know, hellacious down New York and New Jersey, and up here, or like in Situate, there will be small events that people have claims that have damages that aren't even a 1% event. So our maps that we make characterize that. It doesn't mean that in someone's lifetime, 20, 30, 40, 60 years, the reality is that they haven't, in that area, suffered a 1% event. So.
The simple answer for the constituents when they ask you, why did the maps change? It's Congress told FEMA to update the coastal flood hazard zones. It was 2009, Congress said FEMA update coastal flood hazard zones. And so FEMA has just been doing that since 2009. And they started in Connecticut and worked their way up and around Europe.
Yeah, just to comment on, we mentioned the 25% because in the bigger waters bill, they identified property that they felt should have that whole of the subsidized premiums filled faster, and so the 25% only applies to severe repetitive loss property, which is a small percentage that might have a high percentage of losses. It applies to commercial buildings, and the rationale was that, you know, they would be able to pass the cost along so that they should have that hole filled faster. And then secondary dwellings, residences, because they felt that if somebody could afford multiple homes or were collecting, able to collect income and rents, etc., that the subsidies should be fed back faster. Now everybody else, which is the majority of the people, are going to see annual increases. And like I mentioned, it's confusing because there's a 5% that everybody's getting because could start putting the subsidized portion of the premium back in. But I don't know that next October 2014, when they come out with the, with the new manual, whether it'll be still 11 and 12% or what it'll be. They'll look at the current experience. But it's still going to be high.
The other thing I'd add about the maps, 10 years ago, most of the flood insurance rate maps were 20 to 30 years old. I don't know if you saw Brian's presentation. The average map nationwide was made in the 70s. So you can imagine the technology and the topographic data. And for years, we had folks say, these maps are wrong. I mean, how can you say this is valid? They're 20 years old. So we got a special appropriation from Congress in 2003 of $1 billion to start remapping and making new maps nationwide. And then as Brian said in 2009, they said the focus has got to be on the coastal areas. So, did you have a follow-up question?
So if you have a commercial property and you didn't have flood insurance before, are you saying that is going to go up 25% for the next 4 years for maybe it's a small business owner that's in the town? No, you're not saying that.
I think you would mention if they didn't have flood insurance before.
They didn't have it before, but now maybe a piece of their property is in the floodplain. Now they need insurance. Is that going to go up 25% over the next 4 years?
No, because they don't have a policy, they're going to be rated using elevation. So it's kind of day one for them. They won't have the opportunity to jump in on the pre-firm subsidized rates, even though they're being phased out or phased in, to be more correct. If they don't have a policy, they will have to literally be rated using elevation if it's an older building. So a lot of what I'm seeing, I've been in the insurance industry a long time, but there was a fairly healthy market for flood insurance for commercial buildings from the private industry, and I've seen it shrinking, tremendously over the last 5 years. Most of the private companies that will add flood insurance onto their commercial multi-peril policies practically give all the premium they charge for the flood insurance to the reinsurance carrier. And as their market shrinks up, I am seeing some insurance agents say to me, my commercial carrier won't, they'll still write flood because the building's worth millions of dollars, but they want a national flood insurance program to be in place underneath it, and that's, that would be kind of a first. So the biggest thing is that anybody, whether it's a commercial building or a private residence or whatever, just any kind of community buildings, if they don't have flood insurance and they're older buildings, they will have to be rated using elevation. And older buildings in New England tend to have basements, and that's what causes the outrageous premiums.
So we've been asked to get out of here, and so we'll limit ourselves to one more question, so we'll go right here.
I just wonder, I'm an insurance agent, is there ever any talk about increasing the deductibles? I know it's a $5,000 deductible, but they'd let it go to $10,000 or $15,000 or $20,000, let people assume more risk to keep their premiums down. It seems like a kind of a controversial way to mitigate some of the potential.
For non-residential buildings, you can go up to a $50,000 deductible.
50,000?
Yeah.
Residential. Residential's only
You can go up to 5,000, yeah.
Do they ever think that would be a good way to, like, if there's a potential less payout, keep the premium down for people?
I wouldn't be surprised that in future manuals, we can't do these things on our own.
Even a thing like making higher deductibles available, would have to be approved by Congress. But as the premiums go up, it's not, that's a good suggestion for sure.
Can I just ask, I'm sorry, local legislatures have to adopt these maps by next spring, is that correct? So if my town meeting, August town meeting, does not adopt this map, it seems like we have a Hobson's choice. You can take because if we don't adopt the map, then people won't be able to buy flood insurance, we won't get the preferred rate, we won't have access to FEMA grants. Is that correct?
Well, the biggest thing will be that if you get suspended from the program because you didn't adopt the maps, it takes a while for that to become official, but they notify the insurance companies, and maybe a year later, the people will start getting notices that we're not going to renew your policy. They won't cancel it midterm, but they'll say your community no longer is a member of the program, and a copy of that letter will probably go to the banks, and whether they decide to force place coverage or however they handle it. But that would be the most immediate reaction to not adopting them, and that takes a little bit of time for it to actually get down to the policy level.
And the reality of that too is go and try to find someone that will insure. That's why the whole program was created. The private industry did not want it. So they went to the federal government to create it. That's why it was subsidized. So supposedly Lloyd's of London, but even like Bob was saying on commercial properties, all the private insurance companies are dropping out because they can't make any money. There's too many losses. People that live in these high-risk areas.
But we can bail out Wall Street.
Right. Thank you all for coming very much.